Welcome to Open for Business, the Gallatin Valley's only local business and consumer talk show featuring Tom Eaglehoff, the Man Entrepreneur magazine radio called the leading authority in the United States for doing business in small town. Here he is, speaker, author, small business consultant, and Mrs. Eaglehoff's favorite son, Tom Eaglehoff.
All right, welcome everyone. Open for Business. We air every Saturday live from 11 a.m. to 2 p.m. Mountain Time on AM 1450 KMMS in Bozeman, 1340 KPRK in Livingston, Montana. If you'd like to be a part of the big broadcast, go to kmmsam.com and click Listen Live. The call-in number during the show, 406-522-TALK, 406-522-8255. I'm here, you're here. Let's get the show on the road.
Let's get back to Open for Business on News Radio AM 1450 KMMS Bozeman. Lines are open at 522-TALK. That's 522-8255. Here he is. He's big, he's bad, and he's open for business. Tom Eaglehoff.
Thank you, Dan. Welcome back, everyone. It is 25 minutes before the top of the hour, and it's Saturday, July 8th, 2017. It's 85 degrees outside in beautiful downtown Bozeman. I want to welcome you to the podcast portion of Open for Business. Each week I share some tips and tricks I've learned over the years about advertising, marketing, and building strong and successful businesses. And if you missed any of my previous podcasts, you'll find them all on my YouTube channel. And while you're here, why not subscribe to my YouTube channel? And you'll never miss another weekly podcast. You'll also find a link to my podcast on my website at smalltownmarketing.com. That's smalltownmarketing.com. 3,000 people every day visit that website. So get over there and check it out, smalltownmarketing.com. Today's topic, we want to talk about how to read financial business statements. Now, the rules of baseball haven't changed much in nearly 100 years. It's still 60 feet 6 inches to the pitcher's mound. The bases are 90 feet apart. 3 strikes, you're out. But what has changed is how the game is coached and managed. In the old days, when a hitter came up to bat with men on base, you crossed your fingers and hoped the pitcher could get him out. Well, today, the manager not only knows the batter's average, but his average with 2 outs and runners in scoring position. He also knows how the player bats against right and left-handed pitching, and a host of other stats about every player on the opposition as well as his own team. And the same is true in business. Your financial reports provide information about your business, which you should be using whenever you make financial decisions. However, the sad fact is, most business owners only look at a financial statement twice a year. They look at the annual profit and loss statement, the P&L, did we make any money, and their taxes, how much do we have to pay? Well, in this podcast, I want to show you why and how your financial statements can affect your business. So first, let's talk about what kind of information we're looking for. We need to look at more than just the numbers, but also ratios and percentages and how each affects your bottom line. In order to know if your numbers are favorable or unfavorable, you need something to compare them to. So most associations will have these base numbers for your industry and the formulas to calculate them. Yours might vary from the average because of your location, city, or company size. If you're not sure of your industry numbers, check the Small Business Source Book at your local library. Why the library, you ask? Why not just buy your own copy? Well, the Small Business Source Book is a 16-pound book that retails used for $500, so you may want to check it out at the library. Or you can check with your local SCORE group. You can find them online at score.org, S-C-O-R-E.org, score.org. Or do a search for the Small Business Development Center nearest you, search by state, and SCORE is composed of all volunteers, and the SBDC, the Small Business Development Center, they're prepaid with your tax dollars. So most SBDCs are affiliated with a local university, but you don't have to be a student to use those facilities. So let's look first of all at one of our formulas, the cost of goods sold. Cost of goods is producing and converting or buying an item that is eventually sold to your customers. The formula is fairly simple. Your beginning inventory costs at the beginning of the year, plus additional inventory costs purchased during the year, minus the ending inventory at the end of the year equals the cost of goods sold. This should be done for both overall goods and again for each product. Now, the individual process shows which products are winners and increased inventory might be considered, or which are losers and should be eliminated from your stock. Next, let's talk about return on sales. How much do you make per sale? How much does it cost a customer to buy a widget from your business, and how much do you make? Well, you'll need your profit and loss statement, your P&L for this one. Return on sales shows you the percentage made on each dollar of sales. The formula for this, divide net pre-tax dollar profits by total sales. The beauty of this formula is it measures in percentage how efficiently you convert a sales dollar into profit. Now let's look at a cost-benefit analysis. Ever get an idea and wonder if it'll work? Well, the cost-benefit analysis will help you make that decision. Suppose you have an auto parts store and you'd like to expand to other cities. If the expansion cost outweighs the income produced by each store, the move is not warranted. Have you ever had a recall on a household appliance? Companies have to weigh the cost of the recall versus the cost of customer goodwill, potential lawsuits, and customer confidence. The recall may cost the company more in the long run if they don't do it than if they do. Now, could you make more money elsewhere? How much money have you invested in your company? How much are you taking out of the business? Salaries, bonuses, and benefits can have a major impact on any business. So start by dividing your pre-tax profits from your P&L by equity net worth from your balance sheet, and this will show you the return on your investment. If it's less than 5%, you could probably make that in some other investment vehicle. But if you like what you're doing, keep doing it. If not, stop working and start living. And how often do you turn over inventory? As a retailer or wholesaler, you must move your inventory. How much you move tells the health of your business and how well you're managing your inventory. So to calculate this, divide your average inventory into the cost of goods sold from your P&L statement. The higher the number, the more turns you have and the healthier your business is. And also, very important, accounts receivable. You must be paid in a timely manner. Slow pay can put you out of business. You must have a handle on how quick the money comes. So the first step is to compute your daily sales average. Now, if you take your total sales for the year and divide by 365, if you're open 7 days a week. If not, compute the number of days you are open for business. An average collection period can be calculated as follows: 365 days in a year divided by the accounts receivable turnover ratio. So what's the account receivables turnover ratio? That can be calculated by dividing the net value of credit sales during a given period by the average accounts receivable during the same period. So assuming that your company has an accounts receivable turnover ratio of 10 times per year, the average collection period is 36.5 days, 365 days divided by 10. This will show you the average number of days it takes for you to collect from your accounts receivables. Less than 30 days is preferred. 30 to 45 days is acceptable. Almost anything over 45 days may cause a hardship to your business. You must collect accounts receivable in a timely manner to replenish inventory, pay bills, and pay your staff. Learn to do it yourself. Accounting is a lot like practicing medicine. Patient comes in, you put on the heart monitor, take the blood pressure, take blood, other fluids for testing, then the doctor reads and evaluates the test and arrives at a diagnosis. The patient is either in trouble or they're healthy. No, I don't want you to do your own accounting. Most businesses need an accountant just to keep them out of trouble with the IRS. Instead, learn how to read your financial statements so you know what's going on in your business. You really need to look at them more often than just twice a year. You may not always make the right decision, but at least you'll be making an informed one. I don't want you to lose sleep over your financial statements, and you probably won't if you understand what they mean and how they can direct your business in a positive direction. Learn and earn is one of those little keys that separates the successful owner from the unsuccessful owner. So which one are you? And that's the podcast. If you missed any of my previous podcasts, you'll find them all on my YouTube channel. And please subscribe to my YouTube channel. And you'll also find a link to my podcast on my website at smalltownmarketing.com. That's smalltownmarketing.com. So tune in each Saturday, and let's build successful businesses together.